So we are talking of the circular flow of income. And we were saying we'll start with a simple model where income will be flowing from one point to another. And then as we move on, we'll be able to accommodate other aspects. So that is our title for our small illustration we want to accommodate here. And I'll start with a simple model where I'll talk about the two basic economic units, normally the consumer and the producer. Consumer stands in for the households. So here I'll talk about the farms, that is the producers. And here I'll talk of the consumers, the households. This is the best word used in economics. But these are the people who are actually providing us with the services, the labor required in our productions, as well as they're the ones demanding our goods once we have consumed them in, or rather we have produced them in our various farms. So how does the two relate in our society? We are going to indicate the flow of the income from the households to the farms. So we provide what we call the labor as one of the factor input required for a production to take place. So here we talk about labor or other services provided by the people of the nation to the farms for them to be able to produce. Like as we are working for a certain organization, so we are providing the service for the production now for the students, for example, to be called graduates at the end of the day. That will be our product. And when we work for these companies, we generate some income. So there's a payment for the services in form of, let's say, wages, in form of, let's say, salaries, in form of commissions, in form of fees. Those are the kind of returns or rewards to labor as a factor input. We have done that one in farm theory. So there's some payment coming from the farms to the households. But now these people are going to use this particular income generated to acquire the goods and services which are coming from the farms. So goods and services will be available in our various farms as they are demanded by the people of the nation. But they'll not be getting this one free of charge. They'll need to do the payments for the goods and services. So they are going to do what we call return back to the farm in form of making payments from whatever they have generated as their income. They'll use that one to acquire the goods and services. So you see how income is flowing from these farms to the households is that once the households have provided us with the services, we pay them and they use it to acquire the goods and services coming from the farm now, for them to be able to meet their daily wants. This is just but a simple model which shows the relationship between the farms and the households in a particular society. But we don't operate in a vacuum. We operate in a bigger space known as an economy, and we require to be guided by the authority. So we talk about the government here. So how does the government relate with our households? The government provides us with some services. For example, it gives us the health care, It also provides us with education. and so many other things that the government does for the mwananchi in a particular society. So these particular items we're getting from the government, some of them would also include whatever we were calling the transfer payments, like the pensions, the bursaries, and so on. So you see now the income is flowing from the side of the government to the consumers or to the citizens. Here we are talking of the individuals of the society. But whenever we generate our income from your taxation class, you all agree that our income generated out of the various productions we have, we pay as you earn, yeah? We also do an indirect payment or contribution to the government in the name of indirect taxes. So there is that which comes from the consumers or the individuals of the society to go to the government. And this is actually directly from our income. We call it the pay as you earn, or rather the income tax or the personal income tax. And these are also called the autonomous taxation, or rather the direct tax, which are now as a result of the earnings made by the people in that particular country. So this is a flow from now the people of the nation to the government. How does the farm relate with the government? Look at this. The moment we pay for these goods and services, yeah, indirectly, this consumer here, this individual here, is actually making a contribution to the government, where the farm will be correcting on behalf of the government what we call the VAT or the indirect tax. We normally say an indirect tax is actually imposed onto a different person, which is the farm's actuary. And when it comes to the incidents or who end up bearing the burden now, it is a consumer. So the government will be correcting some form of taxation indirectly from the consumer, that is through the payments of the goods and services obtained from those farms. So here we talk about the indirect taxes. And the indirect taxes in the language of NI, they are called induced indirect taxes. These are called induced taxes, because the more we are consuming, the more we are purchasing these goods and services, the more we end up paying that VAT or making that heavy due contribution to the government. So they change in the name of our income. Something that is induced, we say it changes with an increase in the level of the income or a decline in the level of income. The higher the income, the more you make that due contribution, because your consumption actually will also have increased with an increase in the level of income under normal circumstances. The government will also be obtaining goods and services from these farms, the stationery and all the materials required for the projects to go on, yeah? So there are goods and services coming from the various farms that we have in the society. Okay. When the government gets these goods and services from the farms, it will not be free of charge. It will have to do some payment. So you see again now, the government itself is making a payment to the farms, an inflow to the farm. That is, there is a flow of income from one point, that is from the government to the farms. But again, our government does support. It supports what we call our productions in the name of providing us with, for example, subsidies. And subsidies could be in form of, let's say the government has lowered the prices of some inputs, like what was happening yesterday. There'll be that particular way of the people who are in the textile industry being able to acquire the materials or the inputs at a relatively lower price. And that is a good example of a subsidy. Sometimes the government supports the farmers. So in the name of that, there is that flow of the income that we are able to define, that is from the government side all the way to the farms. Our society is a good example of what we call an open economy. An open economy is a society where you relate with other societies in the world, in that you actually do businesses with other nations. There is the trading aspect that we talk about, exportation and importation between our nation and the rest of the world. So Kenya is a good example of what we call an open economy. So we cannot forget about how do we relate with other societies in the world, other societies here. And our relationship comes in the name of what we call uh, exportation and importation, although currently or even some other days we see some hand extended, especially from the World Bank or from the developed nations in support of the less fortunate, the less fortunate nations when they are attacked by different circumstances like the pandemic. In the African region, you see that the government, or rather the World Bank, is extending a hand to help this particular nation. So we cannot just talk about exportation and importation. We also involve what we call the grants, the aids, and so on. Before we now relate our nation, with the rest of the world here, because we have said it's an open economy, and by defining what is a closed economy, actually, it does not have any relation with the rest of the world. It doesn't do trading with the other countries of the world. So when we are defining our society and the relation it has with the rest of the world, we cannot forget, first of all, to define where did these particular farms came from. Usually, the income of a society is defined through the consumption of the goods and services. And when we generate the income, sometimes we don't consume everything. There is what we call our savings. So NI equals to consumption plus the savings. And we said the NI is also the same as the consumption plus the investment. It's out of our savings that we get the amount of money that we can consider to do what? To invest in the society. Or rather, here we have the investment, sorry. So later on, as we talk about the equilibrium level of the NI in the country, we'll have to rely upon that the savings usually are derived from our income generated, and they are the ones which are later on transformed to be the investment in the country. So here we have received some income which have generated because we worked for a certain farm. So this particular payment we are making to the farm to acquire whatever the goods and services coming from the farm, because we want to consume these commodities, then this particular part of the payment is what we can define as our consumption, okay? And also, as we talk about, this is what we are calling the consumption, the payments made by the households in the name of acquiring goods and services from other farms. Then we have received our wages here, the salaries or whatever the form of payment has been made to us, but we have not consumed everything. Not everything that was used in acquiring the goods and services from the farm. We left something here which we call our savings. And from this model that I'm talking about, our savings are the ones which are transformed to be our investment. We create what we call our capital base here. When we create our capital base, even when we borrow money that has already been saved by others. Our savings here creates our capital base, which we now consider to invest, and so we have a business somewhere, or we have an investment taking place in the society. So you see, investment is tied on our savings, that we have it as a balance out of the income generated. We have consumed a little bit of that. The balance is what we call our savings, yeah, and that is what we transform to be our investment, or to be the existence of the farm in the country. But again, from the accounting class, we cannot forget to bring the aspect of what? Look at this. We have the giving back the capital, what we call the allowance for depreciation. So depreciation allowance here is arrived at because of the tear and wear of the capital goods. Remember, when we are doing business, we are not purchasing something like, let's say, unga. No, we are purchasing a machine for us to be able to actually have a production taking place. So that is what defines the production, or that is what defines investment, the purchase of the producer goods or the capital goods. But these capital goods are the assets. They go through the tear and wear. So depreciation has to be allowed for us to be able to give back whatever has been lost by the capital goods, to allow us now to have a chance to produce more in the future in our business. So we provide back to the capital what we call the depreciation allowance, or the capital consumption in the farm. So that is again how the flow of the income would be between our people of the society, who creates the capital base for us to be able to have an investment amount to do a business, and again how we provide back to that particular maintenance of a machine that has gone through the tear and wear, of a motor vehicle that has gone through the tear and wear and it requires maintenance, or it requires some repair work. So that is what we can define again as a flow of income. Now we said our society being open, we cannot forget about this portion, the rest of the world. How does it relate now to our society? There's what we call payments for the goods and services that our people have produced and they're able to export. So we receive, yeah, there are some receipts in the name of the exportation are taking place in the country. We call this one receipts from the exports. The receipts from the exports. When we sell goods and services to other nations, they pay us, so we are receiving from them. Then we don't have everything that we can say it's enough to satisfy our needs in the society. We do import. And when we import, actually, what do? We make payments to other societies. So there's an outflow of the income from our society to the rest of the world. Payments in the name of the import. The more we import, the more there is an outflow of the income from our country to another. The more we export, the more there'll be an inflow of the income into our society. Also, the rest of the world may be providing us with some support in the form of aids, in the form of grants, but we also borrow. These ones we don't pay them back, but we could also be having some loans borrowed in the name of us to construct the highways, in the name of us to deal with the pandemic effects. Let's say our roads have actually been deteriorating for the last 20 years because we didn't have money to maintain them. So as a result of this, we borrow money for development purposes, or even to deal with some kind of calamities which could be affecting the society's performance. So when we borrow loans, we are saying grants and the aids, we don't pay them back. But when we borrow loans, we need to make the payments at the end of the day. So we come and make the payments from a society. There'll be an outflow now, yeah, into another society, yeah, in the name of payments for the loans. And we don't just pay the exact amount that we borrowed. This is what we call a return to the amount borrowed, which we call the interest. So we pay the loans. There's an outflow from our society to where we borrowed that money, and we attach the interest to that borrowed amount. So you see this an outflow of the income from our society to the rest of the world. And that is what we can say. It is a model that represents the circular flow of the income, and more importantly, this flow represents an open economy. An open economy, I've said, it's such a society where it does relate with the rest of the world, that there is that particular business we can do with, let's say, China. There's that particular business we can do with Tanzania. We can also have our people moving to operate in those other nations. There are no such restrictions, for example, that people cannot move out, or other people cannot come to do business in our society. That's what we call an open economy. Closed economy, we don't relate at all with the rest of the world. But in reality, most of the economies in the world tend to be open. A good example is Kenya as our society. So that is what we call the circular flow of income. And that is how income would flow from one point to another in a society.